10 days ago, I invested $1,000 into a project called Sphere Finance. Today, that's worth $1,700. Through its auto compounding and auto staking features, the number of tokens in my wallet has increased by 27%. The token price itself is also increased, so that's where my return is coming from. In this video, we're going to talk about what Sphere is and explain it as simply as possible. We're also going to talk about how they make money. What are the tokenomics? We're going to talk through the trustworthiness of the team and the audits that they've gone through. And we're going to try to answer that question, should you invest in Sphere? If you're new here, my name is Jason, and I'm on a mission to make $5,000 of monthly passive income per month. I've got about a month and a half left to hit my goal. In all of my videos, I try to break everything I'm doing down as simply as possible for you guys. I also share all my wins and my losses. If you get just a little bit of value out of this video, go ahead and hit that like button. And if you're interested in my story or want to hear about more of the projects that I'm breaking down, go ahead and hit that subscribe button. All right, let's get into it. Sphere is calling themselves the S&P 500 of crypto. Basically, they're trying to let their investors diversify just by investing in Sphere. So you invest in Sphere, and Sphere takes that money and they invest in a bunch of other projects. More specifically, they invest in the project's governance tokens. That way, Sphere can eventually get enough governance tokens where they can influence the direction of other projects to a way that the Sphere community is hoping they will. The project's only been around for about a month or so, and they announced their first governance acquisition just a couple days ago on April 6th. They announced in their Discord a lot of things related to governance acquisitions were being worked on in the background. And we talk about their first massive governance acquisition. We're now incubating T2 within Sphere's ecosystem. The T2 acquisition is really important for some of the things that they're trying to do, particularly with something that they're calling quantum liquidity. T2 is very involved in that, so we'll talk about that in a little bit. In their white paper, they also talk about other examples of places these funds will be used. They talk about funding cross-chain endeavors and also other governance acquisitions like Curve, Convex, other degen plays, doing some VC funding directly into projects, and some other over-the-counter purchases. Similar to projects like Titano, they're an auto staking and auto compounding protocol. What does that mean? If you invest into the project, you automatically earn interest on your tokens without having to loan them out to a third party. You do that while the tokens just sit in your wallet. That's the auto staking piece. And then that interest is automatically put back into your wallet, added on top of your balance. And that's the auto compounding piece. So you invest, you hold, and the tokens just keep getting added and added onto your wallet balance. And they're currently doing this at a fixed APY of 99,900%. That's a pretty bold number. Is this sustainable? No. And they even talk about themselves in their white paper. They say this 99,000 is achievable if the protocol can bring in at least the equivalent MAI amount for the Sphere tokens daily from taxation and various other yield generating revenues. If the protocol fails to achieve this, the APY of 99,900 cannot be guaranteed. Props to them for even calling that out. There's a lot of protocols out there that are trying to do something similar, and they're not calling out that their APY may not be sustainable. But let's be real, there's no financial tool or instrument in the world right now that is giving out consistent fixed returns of nearly 100,000%, and that's going to be able to do that for a really long time. It's just not possible. If it is, sign me up. But in the meantime, they are generating some revenue, so let's talk about how that's happening. Every time someone buys or transfers tokens to Sphere, there's a 13% tax. And anytime someone sells, there's a 20% tax. That money is generally distributed into three places. First is the treasury for other investments and marketing. There's also the liquidity pool so that people can freely trade Sphere. And there's also the risk-free value fund. And that's really just a backing price to make sure that Sphere can continue to pay rewards as promised. They also have a whale tax for anyone that owns 1% or more. So anyone that owns a significant amount of the protocol is going to receive higher taxes when they sell their Sphere. That encourages them to hold on and not make big sell-offs, otherwise they're gonna get taxed at a higher rate. The problem with a project or protocol set up this way is that it is hyperinflationary. In order to keep feeding the mouths of all the token holders, they need to usually mint more tokens because the taxes alone aren't enough to sustain all the rewards for everyone else. So eventually they need to come up with ways, or they need to have ways built in that reduces the supply or reduces the pressure of them having to mint more tokens. One way they're doing that is through their black hole mechanism. Anytime someone sells Sphere, they burn a portion of the taxed amount. So you're taxed 20% every time you sell, and a portion of that is burnt forever, and that helps reduce the supply that is in the marketplace. They do claim to be the only project of their kind that has a burn mechanism like that. Someone has to fact check that. I don't know if that's true. Beyond that, they're hoping to make money in the way that they're marketing it, which is this S&P 500 take. Basically, you invest in Sphere, they invest in other projects and really collect a bunch of the governance tokens. And that way Sphere can be influencing the roadmap and direction of other projects and redirect some of their revenue back into Sphere and redistribute that to the Sphere token holders through the rewards mechanism. The last thing that they talk about that is supposed to be truly groundbreaking is something called quantum liquidity pool. Quantum liquidity is a little complex, but I'm going to do my best to explain to you all. What they're doing is they're automatically taking their liquidity pool tokens and they are yield farming those. This happens through the contract automatically. So through their taxes, they take money and they put into the liquidity pool, and that makes it easier for people to trade Sphere. And in return for doing that, they get liquidity pool tokens, and they take those liquidity pool tokens and they start to yield farm them immediately. And that way they can generate other APRs and other revenue streams by yield farming that could be upwards of 30%. The other thing that they're trying to do is they're trying to offer quantity liquidity as a service. QLaaS. I come from the SaaS space myself. It's just pretty hysterical to see that everyone is assing everything. It is fast, farming as a service. It is NAS, nodes as a service. Now we have quantum liquidity as a service. Go figure. All right, let's talk about how they actually do this. So Sphere owns a majority of that project Tet2 that we talked about earlier. This is the Tet2 site. They are yield farming as a service. So you can see you invest into Tet2, they put it into their vault, then they put that through some yield farming strategies. And from there, they earn profits, and those profits are shared with the investors through a profit sharing pool, and also provide liquidity for their own tokens. And then they also invest in other things. But most importantly is this profit sharing piece right here. This goes back into the vault and then can go back out to the investor as part of the profit sharing model. So really what Tet2 is saying is they're better at yield farming than you are as an individual. So they're going to yield farm your money for you, and they're going to keep a piece for themselves and they're going to give a piece to you. So what Sphere is doing is they're automatically taking their liquidity pool tokens and they're putting into Tet2. Tet2 is yield farming that out and then taking some of that profit back and giving it to Sphere. The more money that makes it into Sphere's liquidity pool, which happens automatically based on the taxes in their contract, the more money that's invested into Tet2. And the more money that Tet2 has, the more profits they make and the more profits that they can then share back with Sphere. Now, where does quantum liquidity as a service come in? Good question. Let's see if I can answer it. Like we covered earlier, Sphere owns a large portion of the Tet2 governance tokens. This basically means that Sphere is a gatekeeper for other projects that are looking to use Tet2 as well. And they're already seeing a demand for this as other projects are applying to get into this quantum liquidity protocol through Tet2, which needs to run through Sphere first. So if Sphere thinks the project's reputable, they'll allow it to happen. And just for that, they'll take an upfront fee. Once Sphere allows that to happen, the project then takes its liquidity and deposits into Tet2, just like Sphere did. And because now Tet2 has more money to yield farm, their profit should go up. And because of that, Sphere will be receiving more of the profits that are redistributed from the Tet2 protocol. The more projects that join this quantum liquidity loop, the more profits that Sphere stands to make, because the more profits that Tet2 stands to make. And there's where you can see the power of owning the governance tokens. One thing I should mention is that with Tet2, owning the governance tokens gives you a piece of their profit sharing. Now, the big assumption this whole thing has to make is that Tet2 is actually really good at yield farming and that they're going to be around for the long term. Man, that was tough. I feel like I need a drink after that. Looks like it could be whiskey, right? Just coffee. But if you do want to reward my hard work, go ahead, hit that like button. Because if you're still here at this point in the video, I know you've liked some of it and you've gotten some value. And if you want to do yourself a favor and keep learning like this, hit that subscribe button. All right, let's talk about the team and some of the audits that they've gone through. So you can see they mention it right here on the website that they have the highest KYC by Obsidian. Obsidian is a KYC service that was started by Jesse Eckel and some people that he's friends with. In this case, Sphere has obtained the highest level of KYC offered by Obsidian. So that means their entire core team has shown them their government issue IDs, they've gone through video interviews, and they've all gone through background checks as well. So currently, Sphere is going through an audit by Certik, the creme de la creme of crypto auditing right now. And you can see the audit's still in progress, so it's ongoing right now. As of today, they have a security score of 86. Now, they've also been audited by Solidity Finance, which is another well-known auditing firm. And I've gone through this, and there hasn't been any major issues in here, which is all really good news. You don't want any major issues. Projects like Titanium have gone through the same type of audits, and there are actually some bigger flaws found in their code. And so it's a good sign that Sphere has less issues than other projects that came before. It means they're learning from those projects' mistakes. The team also has a multi-signature wallet in place for the treasury, which is great to see. But for anyone that's new to this space, that's kind of table stakes. If they don't have a multi-signature wallet, that means only one person can sign off on major transactions, and that's never a good thing. Okay, let's talk about their roadmap. Quantum liquidity is still on the roadmap, so they're not doing it quite yet. And if you look at their white paper here, it looks like they actually still may have to transfer their contracts over to a multi-sig wallet. So that hasn't happened yet, and that's something we want to see happen right away. They've also rolled out the Sphere games, which is this deflationary charitable positive sum lottery. Personally, I'm not a huge fan of these things. We talked about in my last video, but basically what you're doing is you are trading in your chance to earn interest on the token to win a big prize pool. You don't lose your tokens, but I mean, it's a lottery. Lotteries are not meant to be good things for most people. And whenever I see these, it feels like it's just like a little distraction mechanism to keep people entertained and engaged while the team works on other, maybe more important things. Besides that, they've got a generic thing here about further governance acquisitions. And according to this wiki, they're also working on this thing called the Dyson index. And what this does, it basically allows you to wrap your sphere. The reason that people want to do this is so that they can avoid the taxes on every rebase. Because in certain countries, every time you receive a rebase, it's a taxable event. They treat it like income tax or short-term capital gains tax. Wrapping your sphere into the Dyson coin, you lock in the amount of sphere that you have, but the value still goes up with the rebases. But instead of you receiving more sphere, the price of Dyson just continues to increase. And that way you can just hold on to the same amount and you're not receiving a bunch of taxable events. It's just like if you were to hold on to Apple stock and it increased in price over time. Eventually, once you sell, you still have to pay those capital gains taxes, but that way you don't have to get hit with the capital gains tax on every single rebase, which in this case happens every 30 minutes. This is something I saw them roll out with Time Wonderland. We all know how that ended, but it's probably a good feature to have, but I gotta admit, had a little PTSD when I read that one. And way down here at the bottom, they have NFTs with utility. I mean, that's like super generic. But let's remember, this project is very young. It's only been on the market for a handful of weeks. And so they have a long way to go, but it's gaining a lot of popularity. One, because we're in this kind of auto-staking, auto-compounding Titano season, but they're also on a different kind of mission. I could see a lot of other projects trying to copy what they've been doing, where they are trying to accumulate tokens of other projects so that they can have a larger say in how those projects are handling their own roadmaps. So, should you invest in Sphere? First of all, none of this is financial advice. I know I have to say that in every video, but let's just be super clear. Again, it is really, really early in this project. This governance aggregation could be a super powerful tool, but the execution is massively important, particularly picking good projects, because you can accumulate all the governance tokens you want of a particular project, but if that project tanks and the price of the token goes down, it's worthless. If you made it this far in the video, you probably like money, and you're probably also a really good person. So I want to thank you for that. That wraps up this first foray into Sphere finance. I will definitely be back with more updates in the coming weeks. If you like this video, let me know down in the comments below. And if you didn't like this video, let me know that as well. I need your feedback to keep getting better and keep driving value for the community. By this point, you know what to do. Hit that like button, hit that subscribe button. And until the next video, I wish you happy learning and happy earning. See you soon.